Right, it is 11 o'clock, so I think we are going to get going. So, good morning, everyone. Welcome, welcome. My name is Danielle. Thank you for joining us to today's session in collaboration with Conveyancing Data Services. So, today I am joined by Matt Joy, who is the Sales and Marketing Director of CDS. And Matt has spent his entire working career in the property industry on one side of the fence or the other, eventually co-founding CDS in 2010 with his two other business partners. So, Matt, are you there?
I am here. Yeah, hopefully you guys can hear me. Yeah, just to reiterate the welcome from Danny. Thanks ever so much for joining us. Miraculously, this is the first time co-presenting a webinar. I don't know how I've managed to get away with it. So yeah, I'm looking forward to it. My main worry is I'm going to hit a button and either cut everybody off or cut myself off. So apologies in advance if I mess it up for you, Danny, but I'll
No,
do my best.
it'll be perfectly fine. Right. So, just a little bit of housekeeping before we get started. As I'm sure everybody is well aware, we're all still kind of working from home. Myself on the South Coast, Matt up in Berkshire, I believe.
Correct.
You should all see a control panel on your screen, which allows you to ask written questions. Please do feel free to submit those as we go along, and we'll try and get them answered either during or after the webinar. There will also be a quick survey at the very end of this webinar, as we're always looking for ways to improve our presentation. So we would really appreciate it if you could take a couple of seconds to provide us feedback afterwards. We are recording today's session, and also we will have a copy of the slides. So if you would like a recording or a copy of the slides, please feel free to reach out to us afterwards, and we will try and get all of those over for you. So let's get going. So today I'm going to start off with a look back on 2020 before taking a look at the outlook for 2021. We'll give you an idea, of course, what's happened. Everybody kind of knows what's happened, but it's always good to review these things. What's been happening in the residential market, what the outlook for construction projects are in the UK, and what has happened and is happening in the commercial property market as well. And also just a few other bits to keep an eye out for this year. So starting with 2020, which was, I'm sure, a challenging year from everybody. Some people have given it a 1-star rating, would definitely not recommend. Please do hold on tight as we go through this insane timeline of last year. Last year was, of course, a challenge. We had a global pandemic, which is still gripping the world at the minute and has impacted almost every corner of this earth. And we've had changes to how we work and how we live, with really lasting effects on our industry and the economy. And we're slowly coming out of it now, so crossing fingers. There's been some positive news, plenty to look forward to in this year, and hopefully possibly even going on holiday this year at some point. Yeah, exactly. What,
Please.
holiday? Looking back at January last year, that was, when we first were informed or notified the world of COVID, and I think everybody kind of forgot that we left the EU on the 31st. So we've kind of forgotten about all of that as of late, and I'm sure we'll be dealing with what's happening with Brexit in the years to come. You've got things that happened in May. By May of last year, over 1 million people had already recovered from COVID. The UK housing had been reopened, which has been an absolute boom since we did it. Since it's opened, and of course I'm sure there's plenty of you that are quite stressed out given the massive workload that has happened since the housing market opened up. We had things like the Eat Out to Help Out scheme in August, and then of course looking at the latter part of the year, furlough had been extended. We also saw Sir Tom Moore, who dusted off his trainers and became the oldest GQ cover store ever, and it was announced that we had come out of recession. Sadly for Tom Moore, he passed away earlier this year, but not before raising an incredible amount of money for the NHS. And then thankfully, Not so long ago, although it feels like it, back in December, we had the vaccines approved and our rollout has been going swimmingly well. So we had quite a lot to take in. And as we move forward into 2021, it is looking a lot more hopeful and seems to be a much better year compared to the last year. So moving on to the residential property, and we'll take a little bit of an in-depth look at what's happened and what's happening moving forward. So this is what the market looked like. At the outset of 2020, who would have known what lay ahead of us? If you remember, there had been an early and significant indication of a property market uplift with a much anticipated post-electoral Boris bounce beginning to ripple through. Now, lockdown number 1 effectively put the property market on hold, but the period since the reopening of this market in May 2020, we saw a level of buoyancy not experienced for over a decade. Pent-up supply and demand, together with a stamp duty holiday from July, resulted in a rapid recovery of the market and rising property prices across the length and breadth of the country, with kind of the exception being London. Now, from the table on the screen, it can clearly be seen that sales agreed are up 10% year on year as the residential property market surged post the first lockdown. Whilst the exchange volume is down 5%, there is significant volume currently in the conveyancing phase. And, Q1 2021, again, has been pretty busy. And it's expected to reverse this decline as buyers and sellers try to beat the stamp duty tapering off midsummer. Price changes and withdrawals are also down as the market buoyancy provides for a more robust market with demand exceeding supply, whilst fall throughs are up. This was a direct consequence of lockdown number 1 and the initial closure of the property market. Now, looking at the property progression pipeline, so there's an estimated 628,000 sales in total, roughly still currently in the legal process in the country, including those that were agreed last year and those that have been agreed this year so far. On average, conveyancing is currently expected to take 22 weeks from agreeing a sale to completion. This compares with about 14 weeks in 2019, and we will talk about delays a little bit later on in this presentation. Interestingly enough, there was actually a little newsletter that went out yesterday via 20CI Group that in the first 2 months of 2021, they've observed more than 56,500 fallen through transactions in their data. The volumes are 37% higher than the equivalent in 2020 and 46% higher than 2019. Approximately 28% of properties within sales agreed are falling through or had fallen through in February compared to the historical norm of 22% at the same time of year. But to put that into perspective, the number of transactions is also going to be significantly higher than normal, or has been significantly higher than normal. And at any point in the last 5 years, we've never seen numbers like this before. So the fall through rates would understandably increase proportionately. Interestingly enough, flats seem to be the losers in this, as they're currently 23.2% more likely to fall through than houses, when 2 years ago that number was just 11.6%.
Danny, that's actually, it's quite an interesting statistic, because we saw in our business, we saw that the cancellation requests in February were quite a lot higher than any other month we've seen before.
Oh, right.
Did that data that they provide tell you, does it give you any timeline to it? Does it explain whether it was early February and as a result of the impending stamp duty deadline, or which I know has been reversed?
I think it's too early to tell, but I mean, we're happy to share that newsletter actually that went around, because it only came out yesterday. But I just thought I'd throw it in there because I just thought it was really interesting. That the fall through.
I think also these
higher.
Yeah, I think these numbers actually show us how resilient we are as an industry as well. They show us how well the industry as a whole copes with things that happen to it. People still want to own homes, don't they? Which is comforting.
Yes. Yeah, and like, we have been really fortunate in our industry that we have been so busy. there are steps being put in place to actually encourage, the renters like myself to buy homes, and we will be talking about schemes that the government are introducing to try and encourage more people to buy homes, even in such a challenging time, right? So we know what lockdown number one had done on the market, but what about the second lockdown? So since October of last year to the end of November, the UK property industry has seen a significant reduction in supply. So of course we've seen a massive increase in demand, but our supply hasn't been able to keep up. New instructions on property coming onto the market fell by 47%, and we also saw a slight reduction in demand at the tail end of last year's sales agreed falling by 19%. So demand was far outstripping supply by some 200 properties a day, which is clearly unsustainable. One can clearly see that the volumes of new instructions since the beginning of October last year really had fallen. So perhaps as lockdown 2 had taken shape, people and vendors' minds had turned to other factors such as Christmas, and I think everybody at that point was already dying for a bit of a break because it was just so busy. Now, in this graph, similar to new instructions, we saw the volumes of sales agreed on property fall late last year. Although the contraction is nowhere near as stark, daily volumes of sales agreed did drop. With sales agreed, however, the key difference on this chart is what happened in 2019. Sales agreed in 2019 in that particular time frame, so in the latter, the last quarter of last year, did fall, but at a much lower rate than the fall occurring in 2020. On a very positive note, even though demand fell, we were still some 1,400 sales agreed per day higher in 2020 than in 2019. So this equates to roughly about 44%. And with supply, we were 660 new instructions per day higher in 2020 than it was in 2019. So clearly there's a big change and shift in people looking and kind of analyzing where they're living and what they want to do with their property and living arrangements. Now, the local authority delays. I'm sure there's a few shivers down the spines of most people when I mention local authorities and the delays that everybody's been having. The stresses and strains that have been experienced by everyone are unbelievable, particularly, of course, to the search providers as well as to you and the conveyancers. We appreciate that local authority delays, search delays, are not the only cause of transaction delays, but it is important to really look at full aspects of the industry. So local authority searches are split into two halves. The first is the local land charge register search, which would uncover any restrictions on the land or the property the buyer is purchasing, for example, confirming if the property is listed. And the second part of the search is known as the Con 29, which I'm sure you're all very familiar with. And this would inform the buyer about any works that might affect the enjoyment or value of the property for the buyer, for example, road or rail works, planning decisions, etc., etc. Now, the chart on the screen illustrates the number of local authorities where search times have gotten worse, better, or stay the same in the last 12 months. And Matt's going to be talking about this as well in the next slide. As you can see, 210 local authorities are experiencing longer turnaround times now than they were in the last 12 months. Only 75 local authorities have gotten better. And in fact, the length of time it takes to conduct a local authority search on average is now 36% higher than it was in November of 2019, whilst the majority of local authorities are reporting search times of within 30 working days. Some are taking a little bit longer, and I'm sure everyone's heard of what happened in Hackney, which reported at one point times of 171 days. And Hackney actually confirmed towards the back end of 2020 that searches will now miss or will potentially still miss stamp duty holiday deadlines. It transpires that the council were subject to an advanced criminal cyber attack, which left them unable to process searches for the foreseeable future. And there have even been a few local authorities reporting that they can't work on or return searches at all. And if there's anything I think we can learn from all of this and what's gone on over the last year is that the industry needs to be, we are resilient, but we need to be more resilient and definitely need to embrace a bit more digital change to the process. I'm going to hand over to Matt with a bit of an update for you.
Thank you. Yes, yeah. Well, the picture in front of you is the infamous Hackney Town Hall, which actually is still closed. Their and indefinitely. So they are definitely going to, well, actually there is no deadline now on the 31st of March, is there? But if it's still been in place, they would be definitely missing those deadlines. So just to add a bit of context to that previous slide, I'm guessing that most of you on here are on here because you've had our email to confirm that. Oh, sorry, you've had our email advertising the webinar, so you should be receiving the weekly update that we send out to everybody, which kind of detail the worst offenders. So I'm not going to go through all 364 councils and tell you what their turnaround times are, but I've got some interesting stats up there. So Hackney still closed, potentially opening in April, but they've not confirmed that yet. So no information coming from Hackney. There are a further 5 councils that are just flat out refusing to do personal searches, so we have to work ways around getting information out of those local authorities, which mainly includes giving them money for it, not in a dodgy way, just in a we have to buy information from them. It's all above board. And so, yeah, and then I won't just read those points out there, but we're only visiting 16 councils at the moment across England and Wales. The majority of them are shut, but working from home. And I think that the councils that have done that really successfully are those councils that have embraced technology, and have databases and systems that allow their land charges officers or other people working in compiling search data to access information from home, and those guys have really kind of embraced not embraced the lockdown, but have continued to work through the lockdown. But there are a lot that haven't. A lot of councils that still work off of paper-based data. I'm not suggesting that they work from Rondexes still, but it doesn't. I'm sure there are probably some that still do. And it's those councils that are really struggling with their turnaround times. The land charges officers have to visit the councils each week. They copy the data they've got and then they email it to us. So that is a real, not to say waste of time, but they're not as efficient as those councils that can access their data from home. And so it's whilst the rest of the industry is really, like I said, embraced working from home. We can do our jobs from home using technology and everything, all the other resources available to us. The problems are with the councils. I mean, I know Land Registry are working with them to digitise certain land charges departments. I mean, that project, if that had kicked off 10 years ago, we would have been in a better position than we are in now, for sure. But yeah, and the last point in the slide I think is really interesting is that we launched, I mean, search delay insurance is not a new thing, but we launched a new range of search delay insurances earlier on, well, at the start of 2021. The usage of those is really low, strangely enough. I mean, it's not surprising now, but before the extension to the stamp duty holiday was announced, we expected quite an increased number of orders for that product, but the usage of it was really low, which is weird. I'm not sure what that indicates, whether people were just really confident that the holiday was going to be extended, or whether they were going to complete transactions without searches. I'm not really sure, but that point was really surprising. I'm not sure that just to kind of wrap up on this slide, Danny, then I'll hand back. I'm not sure that we've seen the last of delays at the local authorities, and there's one reason that it kind of dawned on me whilst I was thinking about this. We've all been allowed to carry holiday over, haven't we? We've all been, most companies, most organisations are allowing their employees to carry a limited amount of holiday over, and over the next 2 years, we've certainly done that. And I know most companies have. I just wonder if the moment that we're released from lockdown and we can
Everybody's
start
going to
going
go on
on
holiday.
again, whether we might see local authorities struggling with their turnaround times and their supply of data due to lack of people, because they're
Quite
all on the beach
possibly.
sunning.
I mean, there's just going to be a mass
Yeah,
exodus,
little
people
word of
flying
warning.
everywhere.
Yeah, little word of warning. Anyway, I hope that was useful. I'll hand back to you, Danny.
Absolutely. No, thanks very much, Matt. The SDLT. So finally, after much speculation, of course, the SDLT. Say that 10 times. The SDLT holiday will be extended until the 30th of June. So after this date, a stamp duty exemption will be kept at double its standard level at 250,000 until the end of September, and then return to its current level, or the normal level, at 125,000 from the 1st of October. In addition to this, it was also announced that 95% mortgages will be guaranteed by the government as part of government's plans to transform generation rent to generation buy. A welcome move. We're sure, will be thrilled by, first-time home buyers. So, but what does this actually mean for our sector? I don't know about you, but certainly from my perspective, my LinkedIn feed has been buzzing over the last couple of months with SDLT talk. And today's conveyancer reported that although 3/4 of people support the extension, the legal industry may have varying different views, as of course you're continuing to fight with backlogs and pipelines, and you're under an increased amount of pressure to try and move things forward. Now, it's estimated by Rightmove that an additional 300,000 property transactions in England could benefit from the extended holiday, saving buyers an estimated £1.75 billion. Rightmove actually saw an immediate spike in activity on budget day following the Chancellor's announcement. It says visits to its website on Wednesday, the 3rd of March, surpassed 9 million for the first time, overtaking the previous record of just over 8.5 million visits recorded just the previous week. In total, home hunters spent a record 71 million minutes on the Rightmove website. And certainly in the Groundsure camp, even surprisingly, we even had questions about people wanting to put their houses on the market after the budget was announced. There was a significant increase in the number of potential purchasers contacting estate agents on that Wednesday, up by 82%. Versus the same day last year. And currently, the average time for a seller to find a buyer is 65 days nationally. And Rightmove estimates that it's currently taking a further 126 days to go through the legal process to completion. So not too dissimilar to what's happening on other sources. Based on this, sellers should be looking to come to market by Tuesday, the 23rd of March, if they want to make sure that their buyers can make use of the tapering and to the stamp duty holiday by the end of September, according to the portal. Having said that, I did have a few conversations with solicitors based in different parts of the country, up in the Northwest, who actually said that it doesn't really, the various tiers, the 500 and then 250, didn't make a huge amount of difference in relation to where they were when it comes to the SDLT thresholds, because a considerable proportion of properties don't actually go up to the 500,000 threshold. So it's been beneficial to many more in other parts of the country where the property prices aren't as extortionate as certainly where I am down here in the South. But needless to say, we've had a huge amount of transactions and requests going through, record numbers, and it will unfortunately continue to do so for the next couple of months. So no holidays just yet. Whilst the extension of the stamp duty holiday may be positive for many, it ultimately means more pressure and work for yourselves and other stakeholders in the home moving process who have really been working around the clock. I mean, I'm getting emails at 11 o'clock at night sometimes, ever since the market reopened in mid-2020. And I mean, I have to say, I'm also checking emails at 11 o'clock at night, so I'm not quite sure what that says about me. Today's conveyancer has launched its Call for Kindness campaign in an attempt to implore the sector to be kind and calm at a time when the pressure is certainly, getting more unbearable. We are absolutely delighted to support in this initiative. Throughout the pandemic, there have been ups and downs and turbulent times all across the sector, and the government helped the property market, of course, with the extension and the taper. All throughout, this is going to impact everyone within the chain. So it's created a huge amount of work for yourselves, and with stress levels through the roof, conveyancing can often seem like a bit of a thankless task. So we do applaud the kindness campaign and encourage everyone to take a moment and remember we are all up against it, but we're all in it together. So we need to try and help and support each other in whatever way we can, whether it is a friendly, supportive call to your colleague or taking a break and having a virtual coffee break with our peers. However you want to show that kindness, please do so. Do it as a small gesture, make somebody's day, and just try and be as understanding and be kind to everyone that we are working with within the industry. Now, moving on. So, escaping to the country. So, there's been a lot of talk of how the pandemic has changed and reshaped the property market as it shifts away from the focus on cities and the commuter belts and move towards more rural locations. Apologies, there is an alarm going off in the background. Hopefully, that's not too loud. People have proven quite conclusively that their job doesn't require them to be in the office 5 days a week. Additionally, people have realized that the desire for a garden or outside space, access to nature, and local communities aren't incompatible with the need to maintain a full-time office job. When the only requirement for being able to do your job in some cases beyond your actual skill is a decent broadband connection, then why tie yourself to a place you don't really want to live in just because it gets easier to work from there? The furlough scheme has inadvertently helped enable people to reassess their homes and allow them to reflect on what is actually important in their lives. It's not just the time saved from the commute, but a renewed appreciation for surroundings, amenities, communities, and fundamentally access to nature. So we wanted to know here at Groundsure whether these clear intentions were already driving real-world results in the property market. So we had a look at our data, and whilst Rightmove and Zoopla saw high traffic towards rural property, was it actually translating into real-life transactions? So we took data from our reporting database, and just to see if we could spot any patterns compared to the previous few years. And the results were, of course, unsurprising, but show some definite trends. We took a closer look at the classifications of areas in which transactions are taking place to get a much clearer picture of the underlying trends. The largest trend that we saw was a move away from large towns and towns in conurbations. So examples would be like Crawley, near Gatwick Airport, Basingstoke, Slough. Transactions in these areas, which are normally highly sought after for their proximity to larger urban areas and transport links, have fallen by 7% since the property market reopened. Conversely, transactions in areas classified as a village or a small community are up by 9%, and transactions of very rural and isolated properties were also up around 17%. So all these trends are well outside the standard deviations we see year on year. Unsurprisingly, there's been no surge towards small towns, which have seen a small drop in demand, though well within the standard deviation. It appears that homebuyers in the wake of various lockdowns are more willing to forgo town life altogether, rather than compromise somewhere in the middle. So we can see a shift away from urban, suburban, and commuter town living towards a rural lifestyle, at least in the short term. Whether this will be a sustained pattern and the effect this has on property prices will have to be judged over a much longer period of time once the market has actually resettled. It seems likely that rural communities with decent facilities and infrastructure will continue to see greater interest beyond historical expectations. So certainly where we are, there's been at least, 10 people within Groundsure that have certainly moved house and really reassessed where they want to be. And I'm not quite sure if that's the case for your team, Matt, but people are certainly looking at where they want to be more.
I do. My only concern is that businesses, you talk about sustainability and will this shift in the places that people want to live be sustainable. But I think the real risk to that is businesses allowing their employees to not come to the office. I mean, we certainly are. I mean, we're, you know, it's been a huge eye opener for us. You know, a massive section of our business we never dreamt would be home based, but actually we've proved quite successfully, quite positively, that you don't need to be near an office.
Yeah.
But my worry is that businesses will forget how successfully they've operated during these lockdowns and start to insist people
Come back.
return to the office.
Yeah, agreed. And I think so. From our perspective, we're certainly, you know, apart from a small team that were field based at Groundsure, we were very heavily office based as well. And we've proven that, just like your business has, we've proven that we're able to work remotely. And so it's trying to find that happy medium. And that's actually been a big question and a big not concern. It's something that we've put on the agenda as a whole business to continue to assess as we move forward. In that, right, you know, a huge amount of the staff were office based. Obviously, we know that that's not necessarily the case. How do we find that happy medium? Do we have half the staff in at, you know, at one point in time, and kind of just make it a lot more flexible for people? And I think hopefully a lot of other industries will be taking looking at that as well.
Yeah, you've got some lovely offices in a lovely location, and the question will be asked, you know, do you need them?
Do you need them? Yeah, absolutely. And I think that is the question. And I'll be talking a little bit about that shift as well, from a commercial perspective, a little bit later on as well. But yeah, it's a really interesting discussion to have, and it's certainly, I think people will find their happy mediums. I think, because certainly from the people I know who have children, some of them do quite enjoy coming back to the office. So it really depends on the situation.
I enjoy having my broadband to myself. That's what I enjoy.
I bet you do. Yes. So certainly one that I think will be a continuing discussion, certainly within our industry. Finally, on all the lockdown talk, so let's look at the current lockdown that we're in, and lockdown 3. So it feels like we've been in it for ages. This certainly for me has been the one that felt the longest and the hardest. So what are the headlines? So the third lockdown is, of course, exacerbating a supply and demand imbalance in housing. Demand has absolutely rebounded faster than last year, but the flow of supply is much slower. London is the only region to register more supply, primarily flats, because everybody's left as owners trade up for space, and or investors take gains ahead of possible tax changes. The strength of demand in 2020 absorbed a lot of supply, meaning we started this year with actually 7% fewer homes on sale or on the market than a year ago. And that's resulted in upward pressure on prices. You've got 3 regions of the country that are recording their highest growth rate since 2007. The annual UK house price inflation is 4.3% overall, and that's the highest it's been since 2017. Impetus for growth is coming from places like Wales, Northern England, and Scotland, where strong demand and attractive affordability allow headroom for above average growth rates. The rate of annual price inflation is highest in Wales in the northwest at 5.4%. At a city level, places like Liverpool has jumped to the top of growth rankings, with house prices rising by 6.3% over the last 12 months. This is the highest annual growth rate they've had for 15 years. Manchester's close behind with a growth rate of 6%, back to levels of inflation seen 2 years ago. The unfortunate thing with the various lockdowns we've had is it also creates reluctance amongst possible would-be sellers. So the flow of new supply on the market is slower than this time last year. It's down by 12%. Sellers are still exercising caution as we start to emerge from this third lockdown. And the one area where supply is, I mentioned earlier, where it's growing or is surpassing is the flat market in London. Also, of course, the lack of homes for sale keeps upward pressure on prices. So a lack of new listings together with rising demand and more new sales being agreed is reducing the available pool of homes for sale. So that is the unfortunate thing. We need to try and keep up with demand, and we are unable to do that. So this is really reducing choice for people who are looking to buy in the market, and will keep an upward pressure on house price growth in the near term, especially if demand remains in line with or ahead of last year. So we'll have to keep looking, but basically there aren't enough houses on the market, so we're gonna it's gonna have to balance out at some point. Moving quickly on to construction. So the pandemic's drastically reshaped the outlook for UK construction activity, as it has for the UK and world economies. Since the pandemic and lockdown, much of the UK economy from late March last year, it inflicted a massive external shock, particularly to UK construction. The value of underlying project starts, so projects with a construction value of less than 100 million, dropped by 46% during Q2 of last year. The second quarter marked a low point in the whole industry. In addition, while severe, the decline in quarterly starts was not as great as initially feared. Contractors were very quick to adjust site working practices, and suspended sites in England and Wales were reopened a lot quicker than people anticipated, with a revival in new project starts following in their wake. Less than 3% of sites are still suspended, and Q3 has seen a sharp rebound. So Q3 last year saw a sharp rebound in construction output and project starts. The value of underlying project starts rose by 19% during Q3 last year, although they still stand roughly about 35% down compared to the previous year. But a more gradual, sustained recovery is anticipated for the next 2 years, a period during which the UK economy will be slowly recovering from the pandemic, whilst also facing Brexit-related disruption to trade and growth. By 2022, the value of underlying starts is forecast to total 49.3 billion, which is just 3% below 2019 levels. So slowly but surely we will get there. Now, the pattern of UK construction activity has been absolutely changed by what's happened in the last year. It's been quite interesting. As construction workloads are rebuilt over the next few years, the best performing sectors will differ from those prior to the outbreak, and the types of opportunities are also likely to evolve. So structural changes are expected to create new opportunities in warehousing and logistics. Historically, office and retail used to be kind of the main commercial premises that were being built, but actually, given the huge shift to online everything, warehousing and logistics has definitely shot up in terms of priority. The residential sector is also likely to see a trend away from high-rise city center residential developments towards low-rise family housing outside of the major conurbations. Increased government funding will drive growth in the education, health, civil engineering, and the community and amenity sectors. Regionally, construction markets in the northern half of the country are set to outperform London and the southeast over the forecast period, reflecting a shift in government funding. So this is really not a surprise, because with the huge shift of online, it's all of the logistics, delivery, Amazon, all of those businesses have had to really take up more space historically in the Midlands, because they're the best place in the country to drive transport and logistics from. So that is becoming more and more of a priority, and certainly taking up more and more of the commercial and construction market. Now, quickly looking at the commercial market. So total investment volumes for the year reached 41.8 billion. So in 2020, a fall of 22% on the previous year, but a strong performance given the market was effectively shut in Q2, which saw the lowest quarterly investment volume since 2009. The year has seen sentiment from the occupational market carry over directly into trading volumes, as historic norms for capital allocations have changed dramatically. For example, and I mentioned this earlier, the industrial and logistics occupational market has seen record take-up driven in most part by online retailers securing space as a result of the pandemic. This has seen investment volumes rise to 8.2 billion, which, whilst it's not a record in volume terms, it does account for 20% of the whole market proportionally, the highest level ever recorded. Alternatives also set a new record at 35% of the market, whereas the office and retail sectors had their lowest share of the market ever at 30 and 15% respectively. The commercial property investment turnover has recovered quite sharply in Q4 of 2020 with 12.4 billion. Whilst the recovery will not compensate for the very low levels of turnover in the previous months, it does give an indication that investors still have confidence in the UK despite the uncertainties of the pandemic as well as Brexit. The most positive trend that's emerged in the last quarter of last year is the return of non-domestic investors to the market, with nearly 48% of all purchasers being driven by buyers from outside the UK commercially. This is actually a marginally higher proportion than normal, something that is particularly impressive given the continuing difficulties surrounding international travel. In the last 2 months of last year, 50% of the deals took place in Greater London from a commercial perspective, a trend that's fairly normal as markets emerge from recession and investors herd towards core assets and locations as part of a wider risk-off strategy. It's not really expected that these last 2 lockdowns will derail many of the transactions that are currently underway in the market, and this will mean that the last 2 months of last year have seen similar levels of turnover. So again, it's not all doom and gloom from a commercial market perspective, and recovery seems to be on its way. In terms of what we can expect for 2021, of course, I mentioned this earlier, the Help to Buy equity loan scheme, which is running from this year until 2023 currently. This allows first-time home buyers who are eligible for an equity loan to borrow up to 20% or 40% in London of the purchase price of a new built home. We've also got things to keep an eye out on, like transparency in referral fees. So transparency over referral fees in conveyancing will drive out bad practice, is what a government official said. Previously, a report from the National Trading Standards Estate and Letting Agency team called for mandatory disclosure of referral fees instead of a ban. Referral fees are certainly a topic that we're going to keep an eye out on. I'm not quite sure, Matt, if you have an opinion on referral fees at all. I just thought I'd ask.
Well, I think you mentioned in the very first slide that I spent my entire working career in the property industry in one shape or form. They've been around since I can remember, and I'm pretty confident they'll be around long after I've gone. So I think regulation on them and transparency on them is probably a good thing, rather than trying to stamp them out. Stamping them out is just going to drive them underground, and they'll happen. They're always going to happen. But I agree that it's good the consumer gets to see them and understand them, rather than them paying them anyway, just being unaware of it.
Yeah, no, I think I agreed. I think I think getting rid of them is probably not the way it's going to go anyway. No, but transparency is definitely a good thing for all parties involved. And of course, like we've already talked about the SDLT to death, so we're just going to have to keep on going and keep on looking at the data to see how this is affecting us. You know, are we going to see a bigger surge in instructions? I don't know. I think it's too early to tell. Are we going to see? We've heard, or at least I have certainly heard of some conveyancers turning work away. Because they just don't have the bandwidth to actually deal with it all right now. I don't know if you've heard something similar, Matt, but it's the workload is definitely high.
We work on some of the larger conveyancing panels providing searches obviously to them, and one of the big problems they have at the moment is finding firms that have got capacity. They're trying to place the work that they've got. That's the problem, rather than finding it. And interestingly, one of the big panels this week has reported a surge in new instructions, so new conveyancing files being opened over the last 2 weeks. And interestingly, obviously, we have access to 3 big estate agents through our shareholders. I don't know, our shareholders kind of in one way or the other work their way up to Connells and Countrywide and the Your Move, Reeds Range chains. One of those is reporting activity 200% of forecasted, where that either means they've been really pessimistic with their forecasting for 2021, or it means that there is a huge surge of work on its way. But obviously they're estate agents, so what they're talking about is properties coming on the market over the last 2 weeks. So that kind of contradicts some of the data that's coming from Rightmove, but that's what they're reporting. So
okay, no, that's interesting. No, absolutely, and like I say, time will tell, and I think, you know, when this is all said and done, we're going to see things and certainly learn a lot when it comes out in the wash. Come out in the wash. But basically, yeah, so, you know, stamp duty extension, the mortgage guarantees, I think, if anything, for me, the interesting or the unknown will be Brexit, because nobody really, like, we haven't really talked about it at all much in the last year. Just because we've been too busy with other things. So as stuff starts to calm down, it'll be interesting to see how that impacts us, whether it's construction labor or raw materials or whatever. It will be interesting to see how that pans out. And that is pretty much it from me and from us today. I hope everybody has found today's session useful. And I just want to say thanks again for taking the time out of your day to attend the session. Just a quick reminder, we've got recording, we've got copies of slides. Let us know if you'd like either. And also there'll be a quick feedback survey that will be launching after this. So we'd really appreciate it if you could take a couple seconds to answer. And yeah, Matt, just any closing words from you?
No, well, to just reiterate the thank you for joining us. It's it's been fun. Thank you.
Perfect. Thanks very much, and have a great rest of the afternoon.